evolved in our country, what about the regulator of the banks, that is RBI, and what all types of banks are there, be it the scheduled banks, what do we mean by scheduled banks and how they are different from the non-scheduled banks, what is the basic difference between public and private sector banks. All these things we'll be covering today. This part, that is the important legislations, it is not being covered in this lecture. Why? Because the RBI Act along with the Banking Regulation Act will be covered in a separate unit, and that is the most important these are the two most important legislations when we talk about Indian banking structure. So let's begin our discussion with the history of banking in India. Although the history goes way back in 1700s, specifically the Bank of Hindustan in 1770, but when we talk about the core institutional credit, which was started by Imperial Bank of India, from there only you will find the specific importance of Indian banking system growing up till today. So formal banking, it started with the establishment of Bank of Hindustan in 1770. When we talk about the Imperial Bank of India, which was ultimately named as State Bank of India, its, you can say, establishment story is a different one. All those banks which were established by the foreign invaders, they were in the metropolitan cities like Mumbai or Bombay. At that time it was known as Bombay. Then we had one particular bank in Madras. Along with that, one bank was there in Calcutta. These three banks were ultimately merged into one, that is known as the Imperial Bank of India. Now when I talk about the Imperial Bank of India, it not only served as the largest bank of its time, but along with that it has certain regulatory roles. So at that time there was no RBI. So till the RBI was there, your Imperial Bank of India was the regulator, or it was performing the regulatory role for the entire banking structure in India. So the earliest precursor of the present State Bank of India was Bank of Calcutta. In 1806 it was established, the Bank of Calcutta, and later on it was renamed as Bank of Bengal. In 1923 the merger happened between Bank of Calcutta, Bank of Madras and Bank of Bombay, and it was termed as Imperial Bank of India. When I specifically talk about SBI, after independence in 1955, that is 1st July 1955, we have the SBI. So recently State Bank of India celebrated its Bank Day also, that is 1st of July. So what is important from this particular slide? Bank of Hindustan 1770, Imperial Bank of India was formed by the merger of which all banks, and SBI started its operation from which date? So 1st July 1955. All these things are very important for the examination. Next, when we talk about some more aspects of the history of Indian banking structure, we must know that at the rural level, or you can say, in order to institutionalize the credit disbursement in rural areas, we had a cooperative movement, not only for the rural credit, but to in general uplift the lifestyle of the rural people. And this rural cooperative movement, or cooperative movement as we know it, was pioneered by Sri Vitthal L. Kavthekar. So you must remember the name, it is important. Question can be asked by the IIBF that the cooperative movement was started or pioneered by which of the following? So Vitthal L. Kavthekar, and it started in the state of Baroda. When we talk about the focus was on village credit, and which specific act was enacted thanks to this particular movement? The Act of Cooperative Societies Act 1904. And what was the aim? The core aim was same: cooperation among the agriculturalists, artisans and persons of limited means. Now these persons of limited means, they used to reside in the remote areas, not only in the rural areas but also certain semi-urban areas as well. So when we talk about the rural credit, the birth of rural credit in India was an outcome of the cooperative movement. That is so true. Next, the major banks in our country, what year was there for all these banks, the establishment year? You will find certain banks like Allahabad Bank, then you have these only Allahabad Bank is there in this particular picture, which was ultimately merged with another bank. But yes, it was one of the old bank that was established in 1865, PNB in 1894, BOI, that is Bank of India, and Canara Bank in 1906. 1908 we had Bank of Baroda. In 1911 we have the Central Bank of India. Being a banker, you must know the establishment year of these banks if you are a part of these financial institutions. When we talk about the regulator, that is the RBI. So it started its operation from 1935 only. But what led to the foundation of this regulator? It was Hilton Young Commission. So it recommended the establishment of banking regulator, which was known as RBI, Reserve Bank of India. It was nationalized in 1948, although started its operation as a regulator in 1935, but post independence we nationalized it in 1948. And after that we had one nationalization of SBI. In 1955, the Imperial Bank of India was transformed into a nationalized bank, which became the first nationalized bank of our country, and that is the Independent India in 1955. In 1956, you will find a reference of more than 200 private insurance companies being merged together and known as the LIC. So these three landmark events happened within a time span of 7 to 8 years. The government also nationalized 14 private banks, and when we talk about, there were two phases of nationalization, one in 1969 and the another one in 1980. What you have to remember from these, you can say, cycles or phases of nationalization of banks, two things. First, how many banks were nationalized in both the phases? 14 in the first phase, and in the second phase 6 were nationalized. Second thing is, what about the deposits? Was there any criteria pertaining to the deposits? So answer is yes. In the first phase, all those banks with deposits over 50 crores were nationalized, and in the second phase with 200 crores they were nationalized. RBI also launched one lead bank scheme. Ultimately, right now we know it thoroughly, because being a banker you must be having some messages from the lead bank manager, and they will be trying to push you towards implementing all the government schemes. But it was obviously started by the regulator in 1969. The lead bank for each district was responsible that time for the credit needs, and still in 2025 also it is performing the same function. When I talk about one more important financial institution in our country, that is the RRB, the Regional Rural Banks. They were established via one act which was passed in the parliament in 1974, and ultimately regional rural banks started their operation. As a part of liberalization and the recommendation of Narsimham Committee, private banks also entered after the economic reforms in 1991. And thanks to this LPG reform, we had the entrance of major private banks like ICICI Bank in 1994. Then we have the entry of HDFC Bank and so on. The licensing of the banks, they were also once again opened up. Now the private banks imbibed the competition within the Indian banking system, and it led to the great amount of, you can say, restructuring in the balance sheet for public sector banks as well. When we talk about the recent institutionalization or reshuffling of our banking structure, so IDFC and Bandhan Financial Services, they were given license to set up the universal banks. Along with that, differentiated banks. What is a differentiated bank? Which has a specific role to perform. Not everything which is being performed by the commercial banks normally, but some specific role is given. Like in the payments bank, they are to provide the payments. that is the deposit. No credit will be disbursed. Likewise, in the local area banks, the local credit will be ensured. Along with that, small finance banks also, which perform a specific role to provide the rural credit for the weaker sections. So when we talk about the timeline, it was in 2015 when the differentiated banks were also established, that is payment bank and small finance banks. One thing which you must keep in mind, that not only the cooperatives, or for that matter your RRBs, but the PSL guidelines also are very important for the restructuring of rural credit. And RBI along with Government of India, they have identified certain sectors, namely 9 sectors are there right now in our country, which are categorized as the priority sector lending sectors. If you have not watched the video of unit number 4th, in which we have covered the PSL norms, it is highly recommended to revisit once if you have, and if you have not, then revisit it again. So now let's move on to the types of banks. As in the initial lecture we were telling that we have 4 types of banks majorly: scheduled, non-scheduled, private and public sector banks. When I talk about the scheduled banks and non-scheduled banks, what is the difference? Scheduled banks are those banks which are mentioned in the RBI Act, and in which schedule? In Schedule 2. Non-scheduled banks, some examples in front of you: Andaman and Nicobar State Cooperative, Manipur State Cooperative Bank and Sikkim State Cooperative Bank. All these 3 are the example of non-scheduled banks. The scheduled banks include in the second schedule of the RBI Act 1934. When I talk about the paid up capital, is there any limit to these scheduled commercial to these scheduled banks? Commercial banks will be looking into the next discussion, but right now let's focus on the scheduled banks. So in terms of the RBI Act, the bank's paid up capital and the raised funds must be at least how much? Rupees 5 lakh. That you must remember. Question has been asked once, that what about the paid up capital? So the answer was 5 lakh. Eligible to borrow from the RBI at bank rate and obtain membership in the clearing houses. The clearing houses, the CCIL, which we covered in unit number 17th, the monetary policy. They must meet the reserve requirements also, the scheduled banks, which is to maintain the CRR with the RBI and to maintain SLR on their own. Further divided into scheduled commercial banks and scheduled cooperative banks. So normally we talk about these, that is scheduled commercial banks, in our discussion, which are in total 6. Starting off with the various normal banks, like your nationalized banks, you have the private banks, then public sector banks are there. Along with that, we also have a specific category for the foreign banks. And these foreign banks, what functions do they perform? Again, I would redirect your attention towards the unit number 4th. There, specifically the RBI master guidelines we have discussed, and for the various foreign banks in accordance with their number of branches. In terms of ownership and function, commercial banks can be classified into 6 categories. We'll be looking into that also. Public sector banks have the largest share of business as well as branches right now. So when we talk about the profitability and everything, you must refer to the RBI circular, which was just now published in, I think, 1st of July only, or 30th of June. It was there. A report was published by the RBI, and it contains everything which you need to know, the points of difference between the private and the public sector banks. So the 6 banks under the scheduled banks, the scheduled commercial banks, they are public sector, private sector, foreign, labs, that is the local area bank, RRBs, payment bank, and your small finance banks. In total, you will find them as 7. Why? Because small finance banks have been added later on. Cooperatives, they are 6. They are 3: state cooperative, and then we have the urban cooperative. Along with that, we also have the district cooperative bank. So DCBs, they are the most important in the cooperative bank structure. If you have to pinpoint towards one particular category which has immense potential and which has already helped disbursing the credit requirements of the backward area people, then yes, it has done very good work here. Now let's move on to the merger. from here one question is expected every year. IIBF asks one question based on the merger of banks, and it is very simple. Being a banker, you must be knowing most of these mergers, but let's revise it for all of you. Starting off with the merger between Dena and Vijay Bank. So Dena Bank, Vijay Bank merged into Bank of Baroda. Oriental Bank of Commerce and United Bank of India merged into your Punjab National Bank, that is PNB. Andhra Bank and Corporation Bank, they were merged into Union Bank of India. And when we talk about the Syndicate Bank, it was merged with the Canara Bank, and Allahabad Bank merged into Indian Bank. So one question is expected this time also. So do make sure after the lecture you note down all these mergers in one note and keep on revising them if you do not know. Now let's see some important points, some important factoids about the public sector banks. Why only public sector banks? Because they form the largest chunk of business activities in our country. So they comprise of SBI, along with that 11 nationalized banks. So SBI, right now we see it as one bank. Earlier it had subsidiaries also. Nationalization of banks held in 69 and 80. When we talk about total nationalized banks, they were 27. Right now we have 11 plus 1 only. However, when we talk about New Bank of India, 1993, this question can also be asked, that in 1993, which bank was merged with the PNB? So the correct answer will be New Bank of India. There were no mergers till 2008, and after 2008 till 2017, there were spree of mergers, including the merger of 7 subsidiaries of SBI into the parent bank. So in 2008, the State Bank of Saurashtra and Indore were merged, and the remaining 5, that is your State Bank of Hyderabad, Patiala, Travancore, Mysore, and Bikaner and Jaipur were merged in 2017. The public sector banks have a number of offices in the overseas as well. So all these important points you must know while studying for the unit number 21. Okay, so this was it for the discussion. Now let's solve some questions based on these. The first question in front of you: the government nationalized 14 private banks with the deposits over 50 crores on 19 July 1969. That is, we are talking about the first phase of nationalization. And 6 more with deposits exceeding dash on 16th April 1980. So what will be the right answer for the second phase? Second phase was for the 200 crore. All those banks exceeding this amount of 200 crore, they were nationalized. And how many banks were they? There were 6 banks. So correct answer is option B. Next, dash was taken over by the PNB in 1993. Just now we have discussed that New Bank of India was the right answer. So A will be the correct answer. Introduction, role of DFIs and major DFIs in India. These 3 will form the part of discussion for today's video. When I talk about the introduction, when you have the commercial banks, why do we need a development finance institution? Reason is very simple. Earlier when the topic was in the news back in 1970s, 1960s, we had limited amount of purview in the commercial banks. We are talking about entire era which was before 1990. So back then commercial banks used to provide only short-term resources. Short-term funding was being ensured. Why long-term funding was not there? Because it involved risk. And at that time, the risk appetite of Indian banks, it was not that high. Their ability to lend for longer periods as required for the infrastructure projects is limited. DFIs are also known as the development banks, and they do not develop only a particular segment. Fine. They are right now developing the entire gamut of, you can say, Indian economy. When we say that entire gamut of services are being provided by DFIs right now, whether it was the same scenario in the beginning, answer is no. Earlier they were very focused on either the industrial growth or for that matter the investment in a particular domain. But now they have n number of services to offer. They play significant role in provision of long-term credit, contributing in capital formation for sustained growth. Most DFIs, they extend the direct finance. Most, this is the keyword, because there are certain DFIs like NABARD, they provide refinancing to other institutes as well. So a brief history of DFIs in India. When you talk about the first DFI, it was IFCI, that is Industrial Finance Corporation of India. And when I talk about the chronology, that is very, very important. Fine, entire chronology is important. Like question can be asked that IFCI, then you have the state FCs, then ICICI, and then you will be supposedly asked SIDB. Whether this particular arrangement of DFIs is in chronological order or not, or you have to arrange it in the chronological order. Such kind of questions have been asked earlier and are expected to be asked from this chapter. So when I talk about 1948 IFCI, then in 1951 we have the State Finance Corporations, ICICI in 1955, LIC 1956. All these are very important. See, these are the most important ones. That's why I have listed here. NABARD 1981, EXIM 1982, NHB 1988. Then SIDB was carved out from the IDBI in 1989. And we have the IDFC Limited also again for the industrial development in 1997. The present, you can say in present 2025, what is the latest one? Out of these, which is the latest entrant here? It is NABFID, National Bank for Financing Infrastructure and Development. So infrastructural developments, you need finance for that, and it is provided directly by the NABFID. When I talk about the direct finance from the DFIs, mostly they provide direct financing, but indirect finance and refinance activities are being carried out by NABARD, by SIDB and National Housing Bank as well, because they not only provide the refinance, plus they have some supervisory role and regulatory role also over the other financial institutions. Okay. Next, when I talk about the role of DFIs, this particular discussion will be more relatable if we start from why DFIs. Fine. Why do we need DFIs, or what was the need back in 1950s post independence that government felt that yes, now we must have DFIs. So DFIs for industrial development, extended term loan for setting up of new units, also for expansion modernization, and thus had a well diversified asset portfolio. So diversification of portfolio was not there initially when we got independence, and DFIs played that role in a longer run. The tenure of financial assistance was usually up to 10 years with sustainable initial moratorium periods as well. So moratorium period, and if we club the moratorium period in the repayment period, it might go beyond 10 years also, which was not at all feasible for the you can say yester era commercial banks. DFIs were funded by government provided equity capital and preferential market access, like channelizing the multilateral funding lines, fund flow from the National Industrial Credit, long-term operations of RBI, SLR, tax saving bonds, all these, the security markets also, they were engaged by the government so that we have a particular infrastructural units for various domains, for various sectors of economy. So the entire, you can say, focus was on either the industrial growth or the infrastructural growth activities and providing the investment opportunities to the various institutions, the financial institution in our country. Next, when we talk about why DFIs were preferred over the commercial banks. So DFIs borrowed medium and long term fund at fixed interest rate for lending for medium and long term projects. Again, medium and long term projects. Back then in 1950s, 60s, 70s, they were not sponsored by the banks. The commercial banks I'm talking about. Government, definitely, it will push them to disburse loans, but it was a risky venture. Then we have the CAS, that is Credit Authorization Scheme. It restricted the commercial banks in going for large ticket long term lending. RBI has stipulated a particular limit beyond which the commercial banks cannot lend back then in 50s and 60s. Also, access to the external commercial borrowings by corporates was not permitted at all. So, external commercial borrowings are not permitted. Then the financial institutions are left with a limited option, and DFIs played that role. The capital market was narrow and shallow with fewer participants. Activity in debt market was absent, and it created good platform for DFIs to have an entry into the Indian economic setup. When we talk about the changing role of DFIs, you will find n number of examples where some DFIs, they were established as DFIs, now they are running as a bank, as a commercial bank, be it a private bank. Or for that matter, when we talk about the reverse of change, you will find certain banks like IDBI, they have been bifurcated into a particular domain like SIDBI. It came out of these IDBI, and now we see it as the SIDBI, which will provide direct finance to the MSMEs. And why this particular role has been performed by SIDBI? Right now, we have the specific ministry, that is Ministry of MSME for the MSME sector in our country. But back then, in 1999, the robust system was not there in order to have the required or the desired investment, or in turn, the turnover of these enterprises was not there. When I talk about the changing role, it starts from the universal banking, a particular phenomena where you will find the reference of n number of services, n number of products which are being offered by the financial institutions to the customers. And these customers do not require any kind of credit. Keep this thing in mind. They do not require any kind of credit. All they need is to have a particular institutionalized way of having these services. So universal banking, although recommended back in 1998, but the DFIs were there since 1950s only. Based on the recommendation of Narsimham Committee of 1998, we saw a shift, a paradigm shift from the role of being a development finance institution to the commercial banks. IDBI, ICICI, these are the prime examples of this particular shift. DFIs to have option to transform as the banks, that is what we were just discussing. Then we have some regulatory framework which was strengthened by the RBI, and the need for this for DFIs was felt if they were to be given greater access to short-term resources. Always remember, whenever we have a shortage of funds and we want to avail the entire services from banking system, we must open some other gateways, and RBI via its regulatory framework, via the regulatory mechanism, it is doing its job since 1955. So when we talk about the recommendations, universal banking recommendation were implemented, and ultimately we saw some good amount of DFIs transforming themselves into a bank. One of them is ICICI. Government also recognized that in the longer run, we won't have many DFIs sustaining their business activities. Why? Because they were focused only on either the industrial growth or investment growth or infrastructural growth. And when you talk about the demand for these services, these are very, very limited. So in turn, you will see that government in 2002 along with RBI, they felt that now we must focus on the commercialization of banks rather than expanding the services of DFIs. So you will find many DFIs like ICICI and IDBI converting themselves into the banks. So ICICI, when you talk about the history, it is Industrial Credit and Investment Corporation of India. It was established as an initiative of World Bank, Government of India and the representatives of Indian industry in 1955. In 1955, you can imagine a scenario, an economy where things are not going really well for the Indian government. They wanted what? They wanted to resurrect the industrial growth. So industrial credit was required. Along with that, investment was also required for our industrial growth. So investment as well as the credit was ensured by ICICI. Along with the government, World Bank was also one of the major stakeholder of this project. Main objective was to provide medium and long-term project financing to the Indian businesses. Long-term project financing, always remember, it means that you are having a type of setup where you will be repaying certain loans, certain obligations based on whatever you have made profits in the entire cycle. If your business is growing, you are making some money out of that business. The money will be first utilized for repaying the obligations and then in the expansion activities. Until late 1980s, ICICI focused on project finance, providing long-term funds. But after 1990s, what happened after 1990s to Indian economy? The LPG reforms came in. So after that, it with its subsidiaries and group companies offered many products and services to the customers. After globalization, it provided many products and services to broader spectrum of the clients. ICICI Bank was incorporated in 1994 and it is now one of the part of ICICI group. We have securities market also under this group. Then when we talk about more ICICI, in 1999, ICICI became the first Indian company and the first bank or financial institution from non-Japan Asia. So it got the recognition in the Asian region also to be listed on the NY Stock Exchange, New York Stock Exchange. It got listed in 1999. Always remember, if the question is asked that which company or which bank in India was the first one to be listed on NY Stock Exchange, it was ICICI. Conversion of DFI into bank, also called as universal banking, offered ICICI the ability to accept the low cost demand deposits. Now it is no longer in the domain of granting medium and long term funding. It can accept low cost demand deposits as well, including the opportunities to earn non-fund based income as banking fee as well as commission. So see, whenever we talk about DFIs, they have a particular motive. They must follow that path. But for the commercial banks, sky is the limit. You can offer n number of services, and while offering those services, you can charge some nominal service charges as well. And from there only profit maximization happens and the expansion is the ultimate outcome. In March 2002, ICICI was merged with ICICI Bank to create the first universal bank in India to offer n number of products and services to the Indian customers. Following this merger, ICICI Limited ceased to exist as DFI. Why? Because once you expand your products, your services in the market, you won't find any role in the DFIs. DFIs are there for a specific purpose, only to perform either the infrastructural purpose or investment purpose, or for that matter institutionalized credit for the long term funding. Fine. Next, when I talk about the IDBI in the DFIs only, IDBI is there for one or two reasons which we have to know. First of all, it started its business in India as Industrial Development Bank. Back in 1950s, when the industries in India, they were not faring well, the government felt need of institutionalized credit for the industries. And this was the first step taken by the government to establish what? IDBI. In IDBI, you will find two important things. First of all, it was established back in 1964 as the wholly owned subsidiary of RBI. Then afterwards, the government had the majority stake there, and from wholly owned subsidiary, its modus operandi shifted towards a commercial bank. Fine. So IDBI Act was amended in 1994 to permit the public ownership up to 49%. Then In 1995, it raised more than 2000 crore in the first IPO, and after that, the ultimate, you can say, method via which the IDBI sustained its business was giving on the stakes which the government held. And right now we see it as one of the private banks, but do remember that IDBI not only provided a bank to our country, but also one of the important refinancer in the form of SIDB. SIDB is there for what? For refinancing the activities or providing the robust credit mechanism for the MSME sector. Okay. When I talk about a basic introduction of microfinance, you must know that what do we mean by microfinance. But before jumping on to the formal definition, let's have a brief discussion about microfinance. We have the commercial banks with us. We also have some NBFCs. Some private money lenders are also there in the economy. Then why do we need such institutions which are providing small amount of loans, very micro amount of loan, not even small, micro amount. When we talk about the credit profile, you will categorize them into micro loans. The reason is very simple. Not only that the private money lenders, they exploit the customers by levying more, or you can say higher rate of interest, charging them with huge rate of interest, I would say. But for those people who are not having any kind of credit accessibility, small amount of credit will also help them. That is the first reason why microfinance. Second most important reason is the rate of interest which is being charged by these MFIs, microfinance institutions. It is relatively lower as compared to the commercial banks. Reason? Because the government wants to improve the living standard of our you can say underprivileged people, the citizens who are underprivileged, or for that matter they are living in a backward area. These two reasons clubbed together, from here the need, or you can say the want of microcredit will arise, microfinance will arise. Second question which comes in our mind, that whether the microfinance institutions, they are providing credit only. Answer is again no. They are here for providing the deposit services, the savings services, along with that credit, plus some pension services also, plus they also have a particular domain where you will be offered some miscellaneous services like the saving module of a particular derivative. So when I talk about all these wide array of services clubbed together for a smaller amount, smallest amount, with a nominal amount of rate of interest, will provide us with the microfinance. So when we talk about this particular definition which is there in the book, that what do we mean by microfinance? It is a financial service which provides small loans, financial services to poor and low income households. Again, the people, the individuals, they are residing in backward areas. They are not having the accessibility to credit. Even if they are having the accessibility, the rate of interest which is being charged by the money lenders, it is huge. So we want these people to come out of poverty. That is the core aim, and have a good or decent lifestyle. Next, it helps in financial inclusion, which enables the poor and low income households to come out of poverty, increase their income level and improve the living standards. Fine. So next, when we talk about the wide array of services which we were just discussing, not only includes the savings, credit, but also includes the insurance, so micro insurance and micro pensions as well. All these four clubbed together will come under the domain of microfinance. Next, when we talk about the genesis of microfinance sector in our country, the development happened in majorly four phases. Back in 1970s, the need, the want for microcredit arose in the country because the agricultural sector was reeling under stress, industrial sector was in doldrums, services sector was almost non-existent. So government thought that let's try to resurrect the small scale industries and try to provide loan to those people who want to start their small businesses, micro jobs they want to do. So in effect, from 1974, with the establishment of Shri Mahila Seva Sahakari Bank, we saw a genesis in the microfinance sector for our country. So 1974, Shri Mahila Seva Sahakari Bank was established to provide financial services to women in the unorganized sector. And this particular bank is treated as the foundation, as the keystone of our MFI development in the country. Next, in 1984, NABARD advocated self-help group linkage as a tool for poverty alleviation. See, NABARD has always supported the SHG model. Since 1984, back then NABARD was having the particular role in RBI only, fine, because one of the part of RBI was agri credit back then. So from that time only, NABARD gave a particular emphasis on the SHG, and in 1984 it was finally done by the NABARD using the SBLP, the self-help group bank linkage program. Upcoming years in 1910s for MFIs or the microfinance sector in our country. What was the reason? There were two reasons again. First, that the government was more keen to take our country out of the poverty, because poverty was surrounding every sector, every segment of society. We were reeling under huge inflation, the inflation levels were high, investment was not there, ultimately leading to economic reforms of 91. And from 91 till 2000, you will find n number of financial activities going on thanks to the investment from the foreign investors. And somewhere down the line, the idea of microfinance took a backstage. But again, it was resurrected in the change period as we know it between 2002 and 2006. You will find specific reference for the secured and unsecured loans. Whenever we have a particular case in the bank pertaining to microfinance, one thing is for sure, either it will be backed by the subsidies or it will be an unsecured loan, fine. So in 2002, norms for unsecured lending to SHGs were aligned with other secured loans. So whatever practices were followed for those secured loans back in 2002 were replicated for the SHGs as well, even when it was an unsecured one. But the landmark event of this phase was 2004, where RBI recognized the microfinance sector as one of the priority sector. And with the categorization as a priority sector, what happened? The priority of the commercial banks shifted towards the MF, that is microfinance. So when I talk about RBI included microfinance within the priority sector in 2004, recognizing MFIs as tool for financial inclusion. Financial inclusion, again a very important topic. In PPB also you will find its reference. In IFS also, in the later chapters of module A, when we talk about poverty, issues faced by Indian economy. So there you must know what do we mean by financial inclusion, and you can add this point there also in your notes, that 2004 RBI, the major aim of recognizing microfinance as a priority sector by the RBI was to alleviate the poverty and provide financial inclusion. In 2006, the nail in the coffin as we know it, fine, for the microfinance institutions, because from 2000 till 2005, this sector was reeling under huge corruption. Everybody who was involved, maximum, I would say, not everybody, maximum stakeholders who were involved in the microfinance sector, they were having corrupt practices, and that forced the government to shut down certain branches as well of certain MFIs, microfinance institutions. So allegations of high interest rate, unethical recovery practices led the government to shut down some branches of the MFIs in 2006. But in the third phase, we will see the growth, fine, growth as well as crisis. Started off with the growth story, ultimately culminating into a crisis, fine. That's a very interesting one, but yeah, that's true. In 2007, you will find private equity players entered the market, leading to rapid growth in the microfinance institution loan book. So when we talk about the economic reforms, as we were just discussing, that investment happened, huge volume of investment were inflowing in the country. And similar was the case for the microfinance institutions also. There also you found numerous private equity players, and they supported the sector back then with 35 billion rupees. That was the approximate number, but yes. In 2009, you will find that MFIN was established. Now, what is this MFIN? Microfinance Institutions Network. It was formed and it allowed the NBFCs, the non-banking financial companies, to become the member. Fine. So NBFCs also chipped in this particular sector. They also started functioning. Operational activities started from NBFC side also. Next, again in 2010, it will be facing crisis as it faced in the previous phase. So the Andhra crisis unfolded, involving coercive debt collection practices that led to borrower suicides. Public awareness, the lack of public awareness which must be provided by the financial institutions was termed as one of the major reasons of these suicides. The government issued an ordinance that significantly again curbed the MFI activities, again closing certain branches. Fine. So started off with the growth 2007, ultimately in 2010 you will have the crisis. Next, consolidation and maturity 2012 till 2015. When I talk about the consolidation, it means that you try to define the functioning of a particular financial institution. Here it is the microfinance institutions. So in 2012, Malegaon committee, the most important committee for the MFIs, it recommended certain changes and RBI implemented the new regulations. Why? Because of the crisis here as well as the previous crisis, where exorbitant rate of interest was levied. So RBI had to intervene in 2012 and try to regulate the lending practices for the microfinance sector. 2014, RBI issued universal banking license to Bandhan Bank. So 2014 is a landmark in itself for the Bandhan Bank, the largest micro lender. MFIN was recognized as a self-regulatory organization as well. So ultimately, when we talk about MFIN, it is what? Self-regulatory organization, so that you can easily promote the lending activities, the services which are provided under the insurance sector, pension sector, and the deposits for the microfinance. The latest, or you can say the most important right now, which most of the bankers are also knowing, was formation of your Mudra Bank in 2015. So this particular event ultimately led, or we can say it was termed as a flag bearer of the microfinance sector, that the establishment has been done in India, but the growth story of the microfinance sector will be started when we are implementing the Mudra scheme, the Pradhan Mantri Mudra Yojana. There were 3 categories of loan: Shishu, Kishore and Tarun. Right now we have 4. What is the 4th category? Do let me know in the comment section. Fine, I want everyone who is watching this session to comment in the comment section what is the 4th category, or who is the latest entrant in case of Pradhan Mantri Mudra Yojana, and what is the amount of maximum loan which can be offered under the Mudra Yojana. Fine. So now let's have a brief discussion about the Grameen Bank model. In this particular model, you will find 2 or 3 good references, good examples that how lending activities should be popularized, how they must be done. Although this model is not from our country, fine, the Grameen Bank model is not from India, but from Bangladesh. Fine, Bangladesh also one of the developing nation. Back in 1970s, from 1970s only, concrete year will be 1976, but from 1970s only the story will start. One major scholar of Bangladesh, Mr. Yunus, he will see that there are n number of villages in the vicinity where he was living, the Jobra village, where private money lenders were charging exorbitant amount from those people who are already underprivileged. They are unable to meet their day-to-day expenses. That is why they have taken loan from the private money lenders. And in return, what they are getting? Exploitation. Money, obviously, they got. But along with that, the complementary thing was exploitation because of the high rate of interest. So Mr. Yunus thought that let's try to lower down the baggage of these people, and he started to lend certain amount of money to 40 odd houses, and that too without any rate of interest. Ultimately, he found out that such kind of collaboration between the lender and the person who is seeking the credit will ultimately lead to greater benefit for the society and will serve the purpose, will eradicate the poverty. Because ultimately in the backward areas, when we talk about the microfinance sector also, what is the major aim? It is to curb the poverty, to raise the living standard of the people who are underprivileged. Fine. So when we talk about the theory, how it works, the global pioneer of finance, microfinance sector was Professor Muhammad Yunus, who experimented with the concept in 1976 and established the Grameen Bank in 1983 in Jobra village, Bangladesh. And for this particular Grameen Bank model, he was also awarded with the Nobel Prize. That is why he is known as a Nobel laureate. Fine, in 2006. He was surprised to know that people were not able to manage even 5 takas, approximately 22 cents, when we talk about the US currency, to buy the raw materials, and that local money lenders charge 10% per week and more, and this would make them poorer. Leave aside the renunciation of their income level. In fact, it is depleting. He lent 856 takas to 42 people of the village, told them to repay without interest. This emotional support was institutionalized by establishing the Grameen Bank. And when we talk about today's Bangladesh, so right now the Grameen Bank model, it has about 2600 branches and has 9 million borrowers with repayment rate of over 99%. So the loyalty of the customers was high thanks to the emotional support which was lent by Mr. Yunus. In this model, the members of the group are also the owners of the bank. So ownership is also being resurrected by Professor Yunus, and he was the opinion that if we instill the management in the lending practices, and the management comprises of those people who actually require certain amount of credit, then the failure, the payment failure can be curbed to a certain amount. Fine. So the group, normally it used to consist of 5 members, and fine, and the SHGs specifically when we talk about the specific scheme of NABARD. Okay, so this was it from my side. I hope that now you know that how you can approach this unit. What is the basic of microfinance we have discussed. Insurance is a type of contract. A contract between two individuals or the two parties where one particular party will be the beneficiary who is paying a certain amount on regular basis. Surprised to know that once you are paying certain amount, how you can be the beneficiary? The ultimate beneficiary will be you only. For that matter, all the risks which are involved in that particular contract will be covered by the another party, and whatever losses have been incurred by the person who is paying a premium on regular basis will be covered by the insurer. Fine. So a particular contract where insurer will be protecting you against any kind of loss, and moreover not protecting but you can say providing for your losses once they have occurred. Protecting, so it will be that it is not occurring at all, but the better definition would be after those losses have occurred, the insurers are providing you with the funds to recover certain assets. So it can be defined as a contract between two parties where one, the insurer, promises the other to indemnify or make good any financial loss suffered by the latter in the consideration for any amount received by the way of premium. So 2 or 3 things are there when we talk about this type of contract, the insurance contract. You will be paying some regular amount of money in the form of premium, fine. Plus, in case of the loss, what kind of loss is there, it will be written in the insurance policy what all is covered, and if that particular loss which has been incurred by you is a component of whatever is written in the policy, then you will be having the money in your account. You will be disbursed that same amount of loss which has been occurred, whether in the business or for that matter in the life. Okay. The contract of insurance is referred to as the insurance policy. When you talk about insurance policy, it is that contract between the insurer and the beneficiary. The beneficiary is doing what? Paying regular payments in the form of premium. The insurer, on the other hand, is providing a type of security to the customer or the person who is paying the premium. Now, when we talk about the important thing for our examination, it is the development of this particular sector in our country. So, insurance sector, how it developed, that is the area of interest for our examination. And not only we will start from the very beginning, but also we'll try to see what are the important acts in between this particular era. So, the oldest mention of insurance in Indian texts were found in Manusmriti by Manu, Dharma Shastra by Yagnavalkya, Arthashastra by Kautilya. Here some reference was there for the insurance. Some reference in the sense indirectly. You can say that the meaning, whatever is written here, can be deciphered to be the insurance contract. Not directly that Manusmriti talks about insurance, no, nothing like that. The major, you can say, event which happened in the modern setup was back in 1818 in India, when the life insurance business began in our country, and it started off with the establishment of OLIC, that is Oriental Life Insurance Company, having the headquarter in Calcutta. This company, however, failed in 1834, but when we talk about the length, 16 years more or less, it was there in the insurance sector. And ultimately, when we talk about the failure also, it was one of the major disasters in the financial sector, because first, it was a new company. The sector itself was new to India. The people were unaware. The business model was not created. Ultimately, culminated into the goodbye of this particular company. Then we had in 1874 and 1897 two more companies, Oriental and Empire of India. They were started in Bombay Presidency. This era, however, was dominated by the foreign insurance offices because of the advent of Europeans also, which did good business in India, named Albert Life Assurance Royal Insurance. So Albert Life Assurance or the Royal Insurance, you can ask your you can say grandparents, they might be knowing about the Royal Insurance for sure. That is one thing. In 1914, the government of India started publishing returns of insurance companies in India. And why the publication of these returns started? In order to create awareness that yes, the money which you are paying as premium is not in a lost cause. You are providing the premium only to be utilized in future losses. The Indian Life Assurance Companies Act 1912 was the first statutory measure to regulate this life business. So when we talk about the act, the major events, they are very important for the examination. And one such act is this act of 1912, Indian Life Assurance Companies, ILAC, because this was the first statutory setup to regulate the life business, fine, life insurance. In 1928, after 1914, directly in 1928, the Indian Insurance Companies Act was enacted to enable the government to collect statistical information about both life and the non-life business transacted in our country. So life plus non-life clubbed together, you have a particular setup thanks to this act, Indian Insurance Companies Act. Do remember, this act will be discussed again in the upcoming slide. Indian Insurance Companies Act. When I talk about 1938, with a view to protect the interest of public, the earlier legislation was consolidated. That is, the Indian Insurance Companies Act and the Indian Life Assurance Companies Act. They were consolidated into one Insurance Act 1938. This 1938 Act will remain for a very longer duration, not only during the establishment of LIC, but also during the establishment of the regulator, that is IRDAI, which with comprehensive provisions for effective control over the activities of insurers. Ordinance was issued on 19th January 1956, nationalizing the life insurance sector, and Life Insurance Corporation came into existence. So LIC was formed in 1956 after the government nationalized the life insurance sector. The LIC absorbed 154 Indian, 16 non-Indian, also 75 provident societies, 245 Indian as well as foreign insurers in all. So every company pertaining to the life insurance was absorbed by LIC, and it had the monopoly. LIC had the monopoly in the life insurance sector till late 90s, because till 1989 nothing happened majorly in the economic setup of our country. But from 1991 the economic policy, the new economic policy came into effect, and it led to the liberalization of the economy. Privatization was also allowed along with the globalization, when the insurance sector was reopened to the private sector. So all in all, you can say that in the history of insurance sector in our country, earlier foreign companies were there, then nationalization happened, then again denationalization, or you can say the opening up of the insurance sector happened. Next, when I talk about the general insurance, that was about the life insurance. Now let's see the general insurance. 1972, with the passing of General Insurance Business, that is the Nationalization Act, general insurance business was nationalized with effect from 1st January 1973. So when I talk about the nationalization of life insurance, 1956, general insurance 1973, and now in 2025 what is happening? Again, we want to privatize some insurance companies. Even if not privatizing, but merger is also there in the mind of the government of one of these general insurance companies or two general insurance companies. 107 insurers were amalgamated and grouped into 4 companies, namely your National Insurance Company Limited (NICL), National India Assurance Company Limited (NIACL), Oriental Insurance Company Limited (OICL), and United India Insurance Company Limited (UIICL). All these 4 clubbed together back in 1973. They were the companies which were formed after the amalgamation of 107 insurers. The GIC, General Insurance Corporation of India, was incorporated as a company in 1971, and it commenced the business from 1st January 1973. Why from 1st January 1973? Because these national insurers started their operation from that particular date only. Now when we talk about a particular setup where you will find a reference of the regulator also, till now, till 1990s also, the early 90s, we are not having the regulator. It is a strange thing because for banking we had a regulator since independence, that is RBI. But when I talk about insurance or securities market, or for that matter pension sector, no regulator as such was there, and that is the reason why these sectors were not having that much growth as banking did. They are part of what? Financial setup only, na? But still they were not having that operational capacity as compared to the banking sector. So when we talk about the reopening of insurance sector, it began in early 90s, and the last 2 decades witnessed substantial development owing to the liberalization measures. Liberalization led to what? More foreign companies were attracted to India, that yes, now the Indian government is not levying much taxes on us, on our company, so we can have the subsidiary here, we can move to the joint venture as well, and likewise we find n number of examples which are there present right now in our country pertaining to the insurance sector, which was reopened back in 90s. 1993, the government set up a committee under the chairmanship of Sri R.N. Malhotra, former governor of RBI. So when we talk about the committees, IIBF has this habit of asking at least 2 or 3 questions every year from the committees, minimum 2 or 3. Chances are there that 5, 6, 7 questions can also be asked from the committees. The name of the committee can be asked, or for that matter, who led that committee, who was the chairman of that committee. Fine, such kind of questions are fairly common in IIBF examination. So when I talk about this committee headed by Sri R.N. Malhotra, so what was the objective? Objective given by the government to this committee was simple, that frame certain reforms for the insurance sector. How we can increase the insurance penetration in our country. How the customers who are using the insurance products, they can be satisfied. How we can decrease the premium amount. All these things. Committee submitted report in 1994. So 93, the committee was set up. Within 1 year, it submitted the report, wherein it recommended that private sector be permitted to enter the insurance industry. So first recommendation was private sector must be there in the insurance industry of our country. Similar to the Narasimham committee, where Mr. Narasimham headed the entire committee and recommended that we must have privatization of the banks. We must have more private banks in our country so that competition is imbibed in the entire sector, and once the competition is there, we will have the ultimate beneficiaries as the customers. They stated that foreign companies be allowed to India by floating Indian companies, preferably a joint venture with the Indian partners. So once you know for sure that yes, a particular foreign company is interested to invest in India, in Indian insurance sector, then you have three choices. First, act like a greenfield project where you will be having a subsidiary in the country. Second, you have some stakes in the already running company. You buy certain stocks of that particular company and run your business in India. Third, the joint venture, share the profits. So that was the second recommendation, second major recommendation of R.N. Malhotra committee. Following the recommendations of the Malhotra committee report, in 1999, the IRDA will be formed. So Insurance Regulatory and Development Authority, IRDA, was established. So after 5 years, the recommendations were given in what, 94. In 1999, IRDA was constituted as the regulator of insurance sector as autonomous and statutory body, April 2000, to regulate and development the insurance industry. Now, what are the important points pertaining to IRDA, fine, for our economy? The key objective of IRDA included promotion of competition so as to enhance the customer satisfaction through increased customer choice. Choices for customers will increase. Lower premiums will be there, while ensuring the financial security of the insurance market. Financial security will also be ensured because you are having a wide array of business activities pertaining to insurance sector now after the, you can say, establishment of IRDA. It opened up the market in August 2000 with the invitation for the application for registrations. Foreign companies allowed to have the ownership up to 26%. This limit has been increased gradually to 74%. Now in this particular union budget, we found one reference where government said ultimately by the end of this year, we will have 100% via automatic route for the FDIs in insurance sector. The authority has the power to frame regulations under section 114A of the Insurance Act 1938. So when we talk about the regulations for that, the regulatory power, it absorbs the regulatory power from which act? Insurance Act 1938, and has framed various regulations ranging from registration of companies for carrying out the business or insurance business to the protection of policyholders' interests. So how a particular company will be set up, insurance company will be set up in our country, how the registration will happen, till the customer satisfaction, everything pertaining to insurance sector has been done by the IRDA starting from 2000. In December 2000, the subsidiaries of General Insurance Corporation of India, the GIC, were restructured again as independent companies. Fine, in 2000 only you will see them as independent companies. Earlier they were under the General Insurance Corporation of India. And this GIC, which was there in 1973 also, it will be converted into National Reinsurer. The Parliament passed a bill for delinking these four subsidiaries from GIC, the NICL, NIACL, OICL and UIICL in July 2002. Insurance sector right now is a major sector. Together with banking services, the insurance sector has added about 7%. So the contribution to the GDP of our country by the banking as well as insurance sector clubbed together, it stands at 7%. What do we mean by ease? So ease of access and service excellence. The full form I expect all of you to remember. Question can be asked from here as well. IIBF can ask question from anywhere. So ease of access and the service excellence. So ease of access is okay, everybody knows what does accessibility means, but whose accessibility we are talking about? We are discussing the accessibility of the banking services and not the entire banking sector, but specifically for the public sector banks. Okay. Accessibility must be there, but along with that, whatever services they are providing, it should be in the excellent format. So they must ensure excellence in whatever services they are providing, right? So ease of access and service excellence, that is the full form of ease. And when we talk about the need of these ease reforms, why only public sector banks? Because they form the largest chunk of the banking system in our country. So public sector banks, along with that, if we club the RRBs, the sponsored RRBs, regional rural banks, they form the backbone of the Indian banking system. And this particular ease reform pertains to the public sector banks and indirectly to the RRBs as well, because they are being sponsored by these public sector banks only. So when I talk about a brief background from where this ease reform emerged, so the reforms emerged from a conclave back in 2017. PSBs, that is public sector banks, reform agenda known as the ease of access and service excellence, that is ease, is based on recommendations government in the PSB Manthan November 2017. So the conclave was PSB Manthan, and here government emphasized the need of reforms to be introduced in the banking industry, and not only for the banking services but also somewhat for the insurance sector also. In a later stage it was implemented, but we will be sticking to the topic, that is ease for the public sector banks. Ease agenda is aimed at institutionalizing clean and smart banking, and the ease banking reforms index, it measures the performance of each public sector banks on 120 plus objective metrics. So when it started back in 2018, you will find not only the themes but the underlying action plans also. So you will be having some themes, like in EASE 6.0 we have certain 4 themes, and underlying we have some action plans. Similar is the pattern followed for EASE 5.0 also, and ultimately for 7.0 as well. So sequential version of EASE, which is there since 2018, started off with EASE 1.0 for the FY financial year 2018-19, then EASE 2.0 for 2019-20, 3.0 for 2021, then 21-22 we had EASE 4.0, and this is the latest one mentioned in the book. Since the book has not been updated after 2023, you will find EASE 5.0 as the latest version. But what if in the exam somebody asks us, IIBF asks this question, that EASE 5.0 is there for the benefits of public sector banks, whether it is the latest version or not. So answer will be no. The latest version pertains to EASE 7.0. Right? Just because it is not mentioned in the book, you cannot say that EASE 7.0 is not existing. Right now it is there. So for our exam, we must focus on the initial 4 versions, along with that 5.0, 6.0 as well as 7.0. Fine. Now when we talk about the most important one, see, always remember, if you are preparing for any kind of exam, what is the most important topic that you must cover in the initial phase only. Only then you will have the confidence, and the chances of qualifying the exam will multifold. And when I talk about this topic, EASE 5.0, chances are really high that question can be asked, if at all, from unit number 28, this particular topic will be touched by the IIBF. Fine. Why I am saying that? Because according to the book, this is the latest one. And when we talk about in journal also, after 5.0, only 6.0 and 7.0 has happened. Okay. So what you need to remember for EASE 5.0 agenda? Always remember how many themes are there. So number of themes, you must remember. Along with that, how many action points are there? So action points along with the number of themes. So when I talk about EASE 5.0, you have total 5 themes and the action points are total 22. So 22 action points with 5 themes. Fine. These basics you must know, the bare minimum. Now when I talk about the themes, do you have to remember the name of these themes? Answer is yes. You cannot just ignore the nomenclature here because directly question can be asked. So what is the first theme? The first theme pertains to the digitally enabled customer offerings. How you are ensuring that the customer services are aligned with the digital banking. So for your MSMEs, you have a comprehensive policy, that is the first action plan. Banking solution for agri value chain. So AVCs, as we know, the agri value chain. We always consider majorly 4 agri value chains prescribed by NABARD. So that must also have a digital form when we are providing those services to the customers. Digital only products and services. So there will be certain products and services only offered to the customer in a digital format. Digital marketing, along with that service excellence through digitally driven customer advocacy as well as feedback. And when we talk about the customer feedback, it has already been implemented in the banks. I know in one of the public sector bank it has been implemented, and the employees are receiving some ratings from the customers regarding their service. Next we have big data analytics. So most of you might have heard this term, big data analytics, machine learning. So when I talk about this analytics, what does it pertains to with regard to banking? So in banking, all the data which is out there in your server, it must be protected first of all, because security breach, the data breach will hamper not only the customer's privacy but also your image, the bank's image. And secondly, when we talk about the analysis, what kind of analysis must be done for the customer's data? You must pick and choose those parameters which will tell you that how you can grow your business, how you can serve the customers better. If a particular customer is trying to go for the home loan, whether you can divert his or her attention towards some additional products based on the requirements. And how you will be knowing the requirements of a particular customer? If you analyze their data in a much more efficient manner. Next we have the third theme, that is your modern technology capabilities. Here more or less you will be building cross-functional teams for faster implementation. Faster implementation of what? Faster implementation of those services which you are offering to your customers. Earlier we used to see that a particular branch is responsible for all type of loans. Now in 2025 or since 2020 only, we have dedicated branches for dedicated loans also. There are loan cells, and in those loan cells not only the loan services are provided but also the awareness is created at the bank's end. The customers will be informed to make a better choice. The fourth theme, it pertains to the collaborative and development focused banking. So collaborative banking, development focused banking, it refers to what? The customers who are residing in the urban areas, if you are providing them top-notch services, top-notch banking services, you should not ignore the customers of your semi-urban or rural branches. The integration of service must be there. It must be promoted across all those channels via which you are providing your services. So when we talk about deepening the financial inclusion in rural as well as semi-urban areas. Fine. Last one, the last theme is employee development and governance. So if a particular employee is having a particular inhibition regarding the service that he or she is offering to the customer, that particular product will not reach the mandated penetration which it should be. What is the reason? The employee is not aware that what kind of products to offer to which individual, and if that particular individual is frustrated for a time period, a prolonged time period, chances are there that he or she will move to some other bank as well, because right now we have n number of options in the market. So employee development, that is training of employees so that they can provide the best option to the customers, and as well as the governance. So you should promote the gender diversity. The policies which are governing your particular bank, they must be focused towards the gender diversity as well. Last one, leadership grooming and development. So when we talk about leadership grooming, you should not be just a branch manager in your branch. You must be a leader. How you can become a leader? If you know in and out of the services which you are providing, and the customers are also happy with your services, as well as it gives you immense satisfaction while interacting with them. So all these things, all these themes clubbed together, you will find a way where you can serve the customers in a better way. And that is the sole aim of these reforms. Ease reforms. Ease of accessibility as well as service excellence. Next we have a particular timeline where major themes of each ease reforms have been covered. Starting off with ease 1.0, where the theme, the core theme was responsive and responsible public sector banks. This was the first ease reforms, the first version of the ease reforms we can say. It was launched to build a firm foundation addressing the key operational and capability gaps to recapitalize the public sector banks. When I talk about the ease reforms, always remember one thing, you will have a particular base, like here we have a base 1.0, over this base ease 2.0 will be built. So whatever action plans are there in 1.0, if they are important in a longer run, they will be included in the subsequent ease reforms version. So ease 2.0 will have the clean and smart banking. It continued to systematically address the root cause of weakness in public sector bank to drive the smart banking. So why the public is so frustrated while availing services from public sector banks? What is the reason? Do ask yourself. The common reason will be one only, the delay in the services provided. The timelines, they are not matching to the demand or what is being offered in the private sector banks. Then we have ease 3.0, where smart tech enabled banking for aspiring India was the main theme. So smart tech enabled means what? You have to inculcate digital as well as data driven next gen banks. The services must be provided digitally, fully digital services, be it the account opening, loan sanctioning, or for that matter FD creation, all these things. Ease 4.0, again tech enabled, simplified and collaborative banking, where you will be using the banking technology, fine, banking technology, so that the institutional changes which are being recommended by 1.0, 2.0, 3.0, they will be implemented in the fourth version as well. Next, when I talk about 5.0, we have discussed this in detail. For 6.0, you have one particular agenda of customer friendly banking enabled by modern capabilities. So the banking should be customer friendly. Okay, you want to enhance your profits, but do not forget the customers in that particular process. Whatever the demand is there, you must meet it via optimum supply. is 7.0, the most important one right now because this is the latest one. And when I talk about Viksit Bharat, that is one theme under the is 7.0. But overall, we talk about the economic development. We also talk about the customer delight as well as the resilient banking. So all these three are the major themes, or you can say the core, the crux of your E 7.0. But when we talk about the elaborated themes, out of that, most important one is this Viksit Bharat theme. And why I am saying this? Because in May 2025, in IFS only, there were 3 questions pertaining to this indirect topic of Viksit Bharat. Questions like, what is the major aim in the insurance products to be provided to the customers by dash year under the Viksit Bharat program? So always remember the year will remain the same, that is 2047. That is the year by which our government has a target of making India a developed nation. Now let's see 6.0. What are the major themes here in 6.0 also? So first theme is delivering excellence in customer service and digital enablement. Second theme is digital and analytics driven business improvement. Now as we have discussed 5.0, if you want that everything is being discussed, all the action plans are being discussed in detail, then directly you can enroll for the paid classes. There you will find in greater detail all these action plans will be discussed, and the entire chapter, or for that matter the entire subject of IFS as well. When we talk about the third theme, tech and data enabled capacity building, so not only for the regular services but also for the debt recovery services, the NPA management must be done via using the technology. The fourth theme, developing people and enhancing the human resource operations. Here the most important part is again promoting the gender diversity, which is mentioned in the EASE 5.0 as well. So 4 themes and again 22 action plans are there in the EASE 6.0. So EASE 6.0 also has same number of action plans, but when I talk about the themes, they are 4 in number. Fine. And lastly, when we talk about the themes of 7.0, EASE 7.0, you must remember the first one, very important, banking towards Viksit Bharat, and by which year? 2047. Second is excellence in customer service, adoption of new age technology and other advanced capabilities like using machine learning, AI, effective risk or fraud management, collections and recovery. So you can say from EASE 6.0 only we have inculcated the fourth theme of EASE 7.0. Developing employees for emerging banking priorities. So the priorities must be set in a particular format and must be inculcated by the respective bank's board. The policy must mention this. So financial market, the bookish language when we talk about, it is a broad term referring to any center or arrangement where buyers and sellers participate in the trade of financial claims such as equities, bonds, currencies as well as derivatives. So currencies, yes, but mostly in this entire module you will find equities, bonds as well as derivatives, their buying, that is their purchasing as well as their selling will be going on or will be talked about. So when I talk about the two types of financial market, they are capital market and the money market. This particular category, that is the money market, that forms our unit number 30th. And what is the major distinction between these two markets? They are having one common difference, which is the duration. The short term we call money market, long term we have the capital market. So market for trading short term financial assets with the maturity of up to 1 year and deals with highly liquid market is known as the money market. It caters to the short-term borrowing needs of the working capital. If you want quick funds for sustaining your business, then definitely money market is one of the best alternate available to you. Because of the short maturity period, it offers highly liquid security, so liquidity of securities will be high. Hence, money market investments are also known as the cash investment. Always remember this. Question can be asked from here also, that what do we mean by cash instruments? Very simple questions are also asked in IFS. So do make sure that you read the definition in and out. Money market definition, if we talk about what are the market investments, money market investments, they are having another term. Why? Because they are liquid enough, and the term is cash investments. Next, capital market, the market for borrowings and lending of medium as well as long term funds above 1 year duration. The duration will be more than 1 year. That is the major difference between money market and the capital market. And when I talk about the money market, all those components which are included in the money market, they are very, very important for our exam. Be it the treasury bills, be it the CDs, the certificate of deposit, or the commercial papers. For that matter, what do we mean by call money market? What is a notice money market and the term money market? How we distinguish them? Let's see. So money market, you have majorly categorized into 3 forms. First one being the call market, call money market, with the duration of 1 day only. The transactions are happening within 1 day. Notice money market for 1 to 14 days. That is the minimum time duration, 1 to 14. For the term money, what is the maximum limit? It will be what? Less than 1 year, because we are talking about money market. But the minimum is 14 days. Fine. Beyond 14 days till you can say 1 year, the term money market is there. So the categorization you must remember. But when we talk about the most important point from this entire money market, you will find the prudential norms as the most important one. Why? Because one table is there in the book also, the Macmillan publication book, and IIBF has this habit of asking questions from the tables. So we will be looking into that as well. So when I talk about the participants in the market, you will have the participants as being suggested by the RBI, as has been finalized by the Reserve Bank of India. So this market is supervised by the Reserve Bank of India, which issue guidelines for various participants in the call or notice money market, as well as for the term money market also. So participants in call or notice money market, which are for less than or equal to 14 days only. Currently, they include banks, scheduled commercial banks, primary dealers, DFIs, that is development finance institutions, insurance companies, and some mutual funds. What are the, you can say, specific names of these mutual funds? It is none of our concern right now. Of these, banks as well as the primary dealers, they can operate both as the borrower as well as lender in these markets. So always remember, your PDs and banks will be having the function of borrowers as well as the lenders. But when I talk about the non-bank institutions, what about them? The non-bank institutions which have been given specific permission to operate in call or notice money market can, however, operate as only lenders. Fine. So a particular distinction has been made here based on the category of the participants. If you are falling under the banks and primary dealers, you can act as a borrower as well as lender. But for the non-bank institutions, you can only act as a lender. Fine. And we have seen that IIBF has this habit of asking questions from such distinctions. So mark this very, very important. Direct question can be asked. Now let's move on to the major topic, that is the prudential lending limits. So when we talk about the prudential norms of RBI, they are not there since the independence. They were not there since the independence. Majorly, the shift happened after the Asian financial crisis of 1995, and right now we see updation on regular basis for these prudential norms. And these prudential norms not only takes care for the general business activities, for the regular business activities of a branch of a bank, but also for the money markets. So when I talk about the prudential limits, what are they for the call money market, notice money market, term money market? Along with that, we must also know what is the benchmark for various participants. The benchmark is very important. If you remember the benchmark, then things will become very easy and you will not get confused between the options while sitting in the examination. So prudential lending limits, prudential limits in respect of outstanding lending transaction in call, notice, term, money market shall be decided by the participants with the approval of their board. So RBI will be laying the foundation of the prudential norms, but different participants, as we have seen, they will be having a particular board of directors. They will formulate a policy for that particular financial institution. Whatever is written in that board's policy will be implemented by the participants within the regulatory framework, the exposure norms prescribed by the Department of Regulation, DOR of RBI. Fine, it is Department of Regulation, do remember, not the Department of Supervision. Fine. So IIBF can ask this question also, and students might get confused, but if you are attending the session, you will be knowing that it is DOR. Fine, Department of Regulation. Now let's see the prudential limits. One by one, we have 4 participant categories. First of all, the scheduled commercial banks, then we will be talking about the payment bank and RRBs. After that, cooperative banks and the primary dealers. So when I talk about the first category, scheduled commercial banks, it includes the SFBs as well, small finance banks. So what about the prudential limits here? Let's have a look. Always remember the prudential limits prescribed by the RBI for the scheduled commercial banks. It has been categorized into 2 types. The first one for the call money market and the notice money market. The second one for the term money market. So for call and notice market, you will have 100% of the capital funds on daily basis, on daily average basis in reporting fortnight. Fine, whatever fortnight you are reporting in, the fortnight refers to what? Within 15 days, and these call and notice money clubbed together, the maximum limit is 14 days only. So what is the benchmark? Benchmark is the capital funds. Based on that, a particular limit has been assigned 100% of capital funds. The next limit is 125% of the capital funds on any given day. So if you are calculating the prudential limit for a particular day, that is supposedly today is what, Thursday. For Thursday, how you will be calculating? 125% of the capital funds, whatever funds your scheduled commercial bank is holding, the capital funds, you will do what? The mathematics, 1.25 times of that particular fund, and you will have the prudential limit. Fine. For the fortnight, if you are managing the entire fortnight, you have the data, then 100% of the capital funds on daily average basis. Fine. So do remember these 2 things, they are very important for the examination, and direct questions can be asked. When I talk about the term money, here things will get interesting. Why I am saying this? The internal board approved limit within the prudential limits for interbank liabilities, whatever interbank liabilities are there, which are being defined by your bank, the prudential norms which are being set by the RBI, and the final board policy, whatever it says for those prudential norms, it will govern the term money market for the scheduled commercial banks as well as the small finance banks. Fine. So term money and call notice money, they are different. Do remember the limits will be determined by different benchmarks. Capital funds here in the call and notice, and the board policy for the term money. Then we have second category as payment bank and RRBs. Here for the three, call, notice and term, only single prudential limit has been mentioned, and the particular benchmark is capital funds. Fine. If you are calculating based on the daily average for the reporting fortnight, then 100%. If you are calculating using a particular day's capital funds, then 125% of that particular capital fund, whatever you are holding for Thursday, supposing today is Thursday. Cooperative banks, so call, notice and term money, here you won't be having the capital funds. Fine. Like in the first two categories, capital funds served as the benchmark for the calculation. For cooperative banks, it is not the benchmark. Then what is the benchmark? It will be the ADs, the aggregate deposits. So aggregate deposits, you must know for a particular cooperative bank, as at the end of the previous financial year, whatever financial year has ended. And what is the limit up to which this benchmark will be calculated? 2% of this benchmark. What is the benchmark? It is the aggregate deposits pertaining to the previous financial year. Fine. Last category is the primary dealers. Now in the primary dealers, you will again find two sub-categorization, one for the call and notice money market and the another one for the term money markets. Here again the benchmark will change, and for primary dealers, do remember the benchmark is net owned funds, okay, NOF. Fine. So for call and notice money, 225% of the NOF as at the end of the previous financial year on daily average basis, if you are calculating for a fortnight. So 225% for fortnightly basis and 2 to 5% of net owned fund as at the end of the financial year, the previous financial year. Fine. So the benchmark will remain the same as well as the limit will also remain the same. Whether you are calculating on the daily average basis in the reporting fortnight or for that matter for the end of the financial year, both will have 225% of the net owned fund as the answer for primary dealers. Okay. If you do not have the access of this particular chart, this particular table, I would highly recommend that just take a screenshot out of this particular video and save it somewhere, because one question is expected for sure from here. Okay. Just take a screenshot. I will minimize everything. Fine. Now, when we talk about this trade which is happening in the money market, how it is conducted, who is conducting it? Obviously RBI, Department of Regulation. But how exactly the mode of operation is working here? Let's see. The trades are conducted on NDS call system, and this system is an electronic system, an electronic screen based system set up by RBI for negotiating the money market deals between entities permitted to operate in the money market. All those participants which we have seen in the previous slide, they can conduct their trade using the NDS call system. So always remember, NDS call system is there for you to promote the trade activities in the money market. Fine. So that is the platform. But how the money market will deal with the money, with the security, with the equity, with the derivatives? The settlement of the money market is by electronic fund transfer, again using the real time gross settlement system, that is the RTGS. Fine. Again operated by the RBI. Now the repayment of borrowed fund also takes place through the RTGS system on the due date of repayment. Always remember, the RTGS system is there not only for the settlement of the money market deals, but also the repayment of the borrowed funds. If you want to repay the amount which is there in the borrowed funds, you will be having the option to settle that particular due on the due date of repayment via the RTGS. Fine. So NDS call system, RBI, RTGS for the general operation under the settlement mechanism of money market, as well as for the repayment of the borrowed funds. Apart from the call, notice and term money market, we have treasury bills, which are very important for our examination. Time and again you will find reference in unit number I think 17th. Yes, in unit number 17th also T-bills have been discussed shortly, very briefly, thanks to the EBLR, the external benchmark lending rate. Then we have commercial papers and CDs, certificate of deposits. The difference between these two, it is very important. One question is expected from here as well, and students are often confused between these two. Call notice money we have discussed. Interbank term market, although an important mechanism, but directly not that important for our exam. Repo agreements, very important, highly important I would say. We have discussed briefly in the unit 17th also. Bankers acceptance, again it is the another mechanism for the money markets, but in the examination questions are not asked from here. Mostly T-bill, commercial paper and certificate of deposits. And if you want to complete the entire gamut of money market, all these products with us, I would highly recommend you the batches which are ongoing right now. You will have simplified form, like here you can see the CPs and CDs, they have been simplified for you